ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today we have a very special guest. Today we have Martin Lakos from Macquarie Bank. Martin is the Division Director of Private Banking at Macquarie Bank, and he's been there for a good 30 years now, I believe.
That's right, celebrating 30 years in June.
That's wonderful stuff, and we want to share your insights and Macquarie's insights with our database, with our clients and our listeners. Martin, thank you so much for joining us.
Thanks for having me.
Let's just start on a sort of a global outlook of the economy. Lots has happened this year and last year, like you touched on. That little sort of summary on the 2023 sort of global issues was interesting, and now 2024. To your point, the economy has stayed extremely resilient.
Yeah.
Given the conditions. What's Macquarie's view of the year ahead and I guess the next 12 to 18 months?
So before we really sort of look and polish off that crystal ball to look to the year ahead, maybe we should just touch very briefly on 2023. And as you know, Theo, this time last year, although inflation around the world was peaking, central banks were still raising rates. There was a lot of uncertainty in the world about the impact of those rate rises. There was expectations that the United States would go in recession, that Europe would go in recession, that maybe even Japan. So the big economies around the world that contribute to global growth were all going to have a significant economic slowdown.
But we've stayed strong.
And this is the thing. Towards the end of last year, it became more and more apparent, and the indicators suggesting that the global economy was far more resilient. And it does look like now that the United States is not going in recession, partially to some extent driven by the fact that the labour market is pretty strong, as we have here in Australia. So having seen that, and it's continued into 2024, look, there's no doubt there's some headwinds for the world and for Australia as well, but the resilience is definitely there. The indicators are holding up reasonably well, and it does start to set us up, we think, for a better 2025. There's going to be some volatility, and some of the data is certainly negative at the moment. Things are still slowing down in some economies, including Australia at this point in time. But it's not a disaster scenario.
Let's talk about those points of data because there's some positive and some negative, right? But both indicating, somewhat of a soft landing by the sounds of things. So the positive data, unemployment, it's crept up a little bit in Australia locally to 4.1 recently, but that's still low. You were touching on that before. Historically, our economy operates around a 5% unemployment rate. In the US, it's still quite strong.
Yeah. And when you've got a tight labour market, although cost of living is higher and there are parts of the community that are doing it tough, and we absolutely recognise that, but households that have got jobs have got cash flow coming in, and so they're managing this cost of living issue. The other side of it is, having come out of COVID, most households were actually in a very strong financial position for a period of time, both in terms of that the zero interest rate regime that we had for 18 months or so allowed households to save more than they've ever saved. So the household savings ratio was the highest it's ever been. And those households that had a mortgage or have a mortgage basically tended to pay off more of their principal because they're paying less interest with a low interest rate environment. So we found that spending continued through the latter part of 22 and into 23, simply because despite interest rates rising, households felt that they had capacity to do so. Now, what's happened, of course, is the time frame by which we're expecting to see interest rate cuts take through keeps getting pushed out because inflation is not coming down as fast as we'd like to see it. And as a result of which, households are now curtailing spending and, in fact, have been drawing on savings. So that's an issue, and that's certainly something the Reserve Bank would be looking at as well.
Those cash reserves have been somewhat depleted.
Absolutely.
But households and businesses are also in a better position through that low interest rate environment because they've also paid off debt and they increased margins and whatnot. So whilst there was this big swing in both direction of high inflation, low interest rates, and now we're going the other way. Everyone's coming out, well, maybe not everybody, but the economy as a whole is coming out in somewhat of a good position.
Which is somewhat surprising because we've had 13 rate rises and the cash rate's gone from 0.1% to 4.35%. The reasoning behind that is obviously to slow and dampen activity, to slow prices, and that's happening. but not to the point where anyone is forecasting recession in Australia. We certainly are not. Are we seeing an economic slowdown? Yes, we are, but not to the point where we think there's a recession looming. I think what's really interesting for businesses is there's some indicators, and they are somewhat lagged, but business investment seems to be holding up reasonably well. Business confidence, although has turned negative, has not collapsed. And the surveys on business conditions, although having gone a bit softer, is still actually positive. So businesses are saying conditions are slowing, but we can do business. And so under this environment of much higher interest rates, it seems that businesses are coping. And so when we start talking about interest rate cuts, which will eventually happen, that should do a couple of things. Certainly improve the costs of funding, of financing debt, both for the households and for businesses. But also, when you start seeing a cut, it should improve confidence. And so that's important as well.
There's two questions I want to ask there, actually. One, when we start seeing cuts, where do you see, to your point earlier, where do you see that landing sort of mark on rates for that perfect economy in Australia? But going back, let's just talk about the data, that there was some negative and positive, which I think ties into that point. Is there any concerning data, either locally or globally, that's one to watch as such?
Look, the main risk, economic risk, is definitely is inflation, and it's been commented by both the Central Bank of the United States and here the Reserve Bank in Australia, that when we think about inflation, it's really two key components. One is around the cost of goods and manufacturing, and that seems to be behaving fairly rationally and normally and starting to come down as economic activity slows. That makes sense. But the services component is not coming down as fast. And that's been commented by the Reserve Bank. And it's that component that will probably force the Reserve Bank to delay any future cuts until they're convinced that the entire inflation component is moving in the right direction towards what we call the range by which they want to manage inflation. And that's 2 to 3%.
Is that because services are a bit more related to maybe wage growth?
Well, wages is definitely a key component, as is rents, as is cost of doing business in certain services arena, the financial services, for example. So they are exerting pressures, or we are seeing costs still rising relative to other costs for businesses, and that's basically feeding into that inflation data. So more recently, our economist has changed the time frame by which he expects interest rate cuts, and has also changed the quantum. A couple of weeks back, we were looking for the first rate cut in Australia to be August, followed by another one in November. And our economist then was forecasting that we would see the cash rate down to about 3.1%, currently 4.35. So 1.25 percentage point move over a time frame. That's been changed, in our view, to the first rate cut in November, or maybe December, but hopefully November, and that we will only see a 1% cut in rates. So from 4.35 to 3.35.
That 12 months onwards, right? From probably November till late 2025?
Yeah, so the cutting process is most likely going to be very conservative by the Reserve Bank. They don't want to drive a significant pickup in demand, having done all this work on getting inflation down and out of the system to the level that they want it. So they're likely to cut and pause, and cut and pause. So it's likely that we may not see that the lower end of that interest rate level, that 3.35, until the third quarter of 2025. So it's going to take a while.
And don't price in this 1.5-2% worth of cuts that some people were...
That's too hopeful.
We're throwing out there.
Correct.
One thing that's crazy is how much the forecast keeps changing. One minute it's rates coming down in August, next minute it's rates going up in August. I think we saw the Judo Bank economist talking about 3 more rate rises to come. And August being that defining period of changes because... going back to your point about data and watching inflation, it's this next quarter of data that's the most crucial, which we'll find out about, I believe, in late July.
Correct.
The quarterly data is much more crucial than the monthly data because some people say, I don't get it. Well, why do we watch the quarterly data when we have monthly data released on inflation, but the quarterly data? is much more comprehensive than the monthly.
Particularly around information that feeds into the inflation data around services. So the monthly data is useful in terms of trends, but it's not a complete picture. So we're still reliant on that quarterly data for sure. And look, there's been changes to the calculation on inflation by the ABS about a year or so ago. Hopefully more comprehensive. The information is even more accurate than what it was in the past. But again, the central bank, they're not going to wait for inflation to be in that range of 2 to 3%. They'll just start cutting rates, in our view, when they're convinced that it's going to get there. And at this stage, the services component is not quite convincing enough yet. So unfortunately for households and for businesses, we've got a little bit more of a wait before we might be able to see actual rate cuts looming. Now, when that does take place, clearly that's going to be good news, both in terms of the actual cost of funding, as I mentioned before, and it should give a bit of a boost to confidence.
So let's relate this all back to our listeners, which are, predominantly homeowners or soon-to-be homeowners, buyers, vendors, landlords, and even our real estate partners that are all tuned in here. How does this landscape sort of affect the housing market? We've got we've spoken about this countless times, but we can touch on it again. The huge increase in population. We've got a housing crisis. Doesn't that somewhat make it, a very positive outlook for the property market in terms of prices?
Well, we've seen that, haven't we? I mean, there were some forecasters through COVID that we're going to see a 30% collapse in house prices. That obviously didn't eventuate, and
went the other way around.
We never thought that was the case. We've now got house prices, up again, and we're seeing monthly increases around most capital cities, driven obviously by this shortage. But let's just put the housing market to some extent into some perspective. If we think about housing pre-COVID, we already had a 30 to 35,000 shortfall of freestanding homes in Australia. Demand was such that we should have been building a lot more homes through that period.
Supply was already an issue going into COVID.
Correct. Then obviously coming out of COVID and with this population increase that we're finding ourselves, it's just exacerbating the housing shortage situation. There's another element to this, which of course is the construction industry. So not only are they finding the cost of doing business has been rising, but right through COVID, the cost of building materials rose anything up between 30 and 40%. And the supply of those materials was also a problem. And then we're also finding a skills shortage in the construction market. So the numbers that we've seen in the population growth that we're experiencing now, out of the 600,000 people that's come to Australia, apparently only 1,000 of those are plumbers. So we need to be encouraging more building skills, more trades to be coming into the country because the building recovery is not going to be 1 year or 2 years. It's going to be a long time frame. And so those skills will be well utilised for quite some time. So the ability to build has now been delayed somewhat. So unfortunately, this housing crisis, there's no quick fix.
Yeah, I was about to say there's no quick fix for this.
But what we will see is that when rates start coming down, there's probably more likely to be, developers and investors more prepared to devote some funding to new housing. Also, we'd love to see more impact from governments, particularly around build to rent, so the lower cost housing as well. So there are a number of elements that we need to see to proceed. But again, starting today could take 2 years before something's finished.
Well, let's just touch on those three things you just called out, because I feel all three things are starting to turn around. So let's talk about investors are coming back into the market.
It appears so.
We've seen that investors in residential properties to give tenants a place to live and improve this vacancy issue, that's turned around. It's now looking like we're seeing more people looking at purchasing an investment property in their super or whatnot, just because yields are improving because of rent increases. Building approvals is looking better now.
Starting to. It's early days.
It's early days, but
it looks like it's bottomed.
It's bottomed and it's going back the other way. And thirdly, your comment on governments. Despite what we've covered off in previous podcasts with previous guests, we were talking about in the past that state government will come out with these great initiatives, but then local councils would have these overarching policies which would somewhat kibosh these initiatives, right? And let's talk about subdividing a house into two dwellings, or doing one of those duplexes or whatnot. Whilst the state government might release these new sort of laws for councils to adopt, they would kibosh them and prevent this from happening.
Well, the approval process was delayed. My understanding is that the New South Wales government is actually working towards to de-bottlenecking some of these issues. So that's going to help.
Yeah, that's my point.
But again, it's not a quick fix.
It's looking like it's changing. Only in the last week or two.
That's right.
Now the state government will overrule councils.
Yeah.
And that's a fantastic initiative, in my opinion.
Yeah. Look, it's probably much needed because we've found that there's been significant delays in approvals by councils, and that's just added to the added delays on the ability to build, to find a builder, and then to get going on approvals and finance. So those things are definitely improving. But none of them are a short-term fix.
Yeah,
there is
exactly.
not a short-term fix there.
I think you said earlier in our catch-up, it's a 2-year lag when someone gets the approval and actually starts construction.
Correct.
Basically.
And look, the other side of it is if you think about the cost of building, something like 32 to 35% of the cost of building a freestanding home, so that's buying a block of land and building a home, 32 to 35% of that cost basically are government charges. And so maybe that needs to be addressed as well.
Yeah, on the other thing of supply, there's a hot topic at the moment that's making a lot of airtime in the news and a lot of airtime in our world of finance because it's a bit of a hurdle for us, but these modular homes that they build in a factory and they drop on those house and land subdivisions just to be able to build more houses in a timely manner. I guess 10 years ago there was speculation and skepticism on some of the home builders building these house and land subdivisions. Now they're going to be viewed as the more prestigious product compared to some of these modular homes that people are looking to put on these sites.
Yeah, look, I think there's going to be a number of answers. You know, people come up with good ideas to get some volume of housing established for sure, and that's definitely would be considered one of the areas.
So let's move on. Another big topic. Cost of living crisis. We talked about the recent budget, and there was also speculation there that maybe some of those changes were inflationary. I agree with your comments earlier that they're probably neutral. The $300, for example, $75 a quarter for an energy rebate is not going to really change the household's sort of living arrangements or
Look,
expenses.
it's going to help a little bit, but there's a bigger issue around, obviously, with a growing population, much needed critical infrastructure. So it's not just roads and rail, it's obviously things like water and access to power and schools and education, hospitals. So these are big picture perspectives, and as the population grows, and let me just quickly touch on the population. Pre-COVID, Australia was growing at 1.8% population growth. And in those days, that was the highest rate of any country of the OECD. We're now growing at 2.5%. And again, we've got the record of the fastest growing population of any OECD country in the world. So with this population growth, we need some planning and infrastructure spending to take place. And again, there's no quick fix on this, but we do need to see more activity. And energy is one of the key critical components. I think that again, there needs to probably be some better thinking in terms of vision to support this growing population of ours.
Can we just highlight that comment you said there about the fastest growing population in the OECD? We were prior to COVID also?
Correct.
And post.
So pre-COVID, we were growing at about 400,000 people a year. That's 1.8% of Australia's population. About half from natural means, about half from immigration.
Wow.
So now the natural means is still ticking along, and it's well publicised now, the amount of people that are coming to Australia.
So all that commentary around the population change and growth being sort of excessive as such from this current migration level, it was a growing population at aggressive levels prior anyway. So the housing necessity was there, just to your point again earlier, that we already had a housing sort of shortage going into COVID.
Look, Australia needs population growth and it has positive economic impacts. And clearly, this is a fabulous country, isn't it? So we can understand why people want to come and live here and work here. Lifestyle, it's a wonderful country. But, again, there's lags and leads, and we've got this population growth and we haven't got the infrastructure or the housing to support that just yet. It'll happen. There's some imbalances growing.
And speaking of this country being a beautiful place to live and having a somewhat of a positive economic outlook, right? You touched on earlier that the sort of two major contributors to that. You just touched on it just before, but the infrastructure spend, our government governments are spending, both state and federal, great amounts of money on infrastructure, which is giving good amounts of employment and jobs in the workforce, and that is being somewhat supplemented, or I guess fulfilled by our big miners paying huge amounts of tax. A lot of people give some of the mining companies a bit of a bad rap, but you look at BHP, the largest taxpayer in Australia. I think I read it's about 13 billion a year they pay in tax.
Yeah.
And that's really supporting our economy.
It absolutely is. And look, right through COVID, when obviously there were supply chain disruptions, we found that commodity prices took off. And in fact, the iron ore price hit an all-time high from a cash market perspective. And so these mining companies were doing very well, had large cash flows, very profitable. But there is what we call the trickle-down effect from that, and those improved terms of trade. In fact, the terms of trade for Australia are at all-time highs, which is reflective of that. And what we find from that, the high commodity prices that we've enjoyed, is that companies started investing, which means they were expanding production and operations, which meant they had to employ more people for that expansion. So they were creating employment, which is great news, and they were investing. They were paying higher dividends to investors. Those investors could either reinvest in companies like BHP or invest elsewhere. So it started an investment cycle. And what you touched on, obviously, is that because they were so profitable, paying a very high level of tax. As a result of which, our national debt position is actually in a much better position than had been forecast. And that's clearly good news. Now, there's no doubt, like everyone else, our national debt is also, the cost of servicing that debt is higher because interest rates are high around the world, but the actual principal sum is in a much better position than we thought it would be on a post-COVID basis. So again, that puts us in an okay position.
Speaking of dividends, I do recall, I think, was it 2021 or 2022, those big mining companies, they were paying like between 8 to, I think Fortescue was paying 14% as a dividend yield. So it's fantastic profits for investors. No wonder some of them have almost doubled in the last sort of 2-3 years in terms of market cap and value. So let's tie that back into this cost of living crisis going on. Once again, just like the housing crisis, you could say, no quick fix, right? Nothing overnight that the federal government could have put in the budget that was going to change the pendulum too much. But it looks like I don't think we're going to see crazy increases moving forward in things like energy.
No, it doesn't look like at this stage. Obviously, it's driven by policy, and we can look at that and decide that the best way of getting energy prices down is actually creating more energy. Increased capacity. That's going to happen over time, but it's going to happen slowly. It's interesting that in the newspapers today, the New South Wales government is now looking to negotiate to keep the Eraring power station open for longer, because there's a recognition that the reliance on renewables, although very important for the environment and very important as a source of power, we're just not there yet. And exactly right. And technology is not allowing us to be that. So, for the environmentalists, unfortunately, we're going to be far more reliant on coal and or gas as transition elements, hopefully more gas and coal, for a longer period of time until we have higher levels of capacity being driven by other forms of power, such as wind and solar, and obviously gas as well. So that we're going to have to get used to having that mix. But again, it's interesting the New South Wales government has made this decision, because I think there was probably some concern that if they didn't move, we might have some problem in terms of the ability to supply power.
In terms of I guess businesses and how this is relating to households in the current economic climate, the other thing that you touched on in that catch up this morning was a bit about wage growth, and how the wage growth, somewhat being driven by a low unemployment market, but also, I guess, households needing higher incomes and chasing higher paying salaries. And there's a lot of sort of transitioning from one job to another through COVID. It sounds like that's plateaued, and wages have peaked, and we're seeing a bit of a sort of a correction in the other way in those enterprise agreements and individual agreements.
A little bit of history prior to COVID, the inflation rate in Australia was actually below the range the Reserve Bank manages inflation, so below 2% in fact. And that was reflective of the fact that wages growth was very, very are low. So wages really wasn't even keeping up with 2% inflation. Now that we had inflation take off, clearly wages were well behind. And so every household's got a right and expectation that their income will at least match inflation, the cost of living. And it hasn't done. So we've had this process of wage claims and wages growth. But the structure of the Australian workforce has also changed. And so there's more enterprise agreements and agreements directly with businesses on contractual side as against the award side. So that's just a structural change within our economy.
Well, let's highlight that change. So the award side is, I think you're calling out, it's about 8% of the workforce,
if you exclude the public service.
Yeah.
So, the public service is unionised, and they are obviously subject to award and wage structures. Outside of the public service, about 8% of the working population basically are paid on an award basis.
So the majority is this enterprise and individual agreements that you're referring to.
We've had a significant expansion in the workforce by people working for themselves, so contractors. The services industry has taken off, and to the detriment or decline in manufacturing, for example. And manufacturing was always typically more unionised than before. So we've had this structural change. Having said that, households' expectation of wages meeting cost living is more than realistic. And we've had this wage cycle take place. But we're also finding now that when we look at a number of indicators like the Seek.com job ads index, which has now turned over, that's the number of ads that businesses are putting out to gain new workers, skilled workers, professionals. That's slowing down. So it would be certainly a suggestion that the unemployment rate, which is starting to rise, it's now at 4.1%, was 3.4, will probably continue to rise somewhat. But pre-COVID it was 5.5. So, we would expect to see a softer labour market. That will start to see a softening in the demand on wages. So that part of business costs will probably start to improve somewhat. Also because your wage outcomes have now been made. The businesses are probably less likely to look at more wage demands as inflation is coming down. And that would be sensible as well. In regards to cost of living for households, we've touched on energy. Well, we need to see energy household retail energy come down in pricing, and the economics of that is we need to see more energy produced. Greater supply will see pricing start to come down, and probably not subsidies that are in the recent budget is not the long-term answer. It's great relief for households, and that's a good thing, but it's not a solution to the longer-term energy cost outlook.
Without getting too political, what was your summary of the recent budget?
Look, I think I'll leave it that it appears that it was neutral, not a terrible thing for any government of any political persuasion to be managing the budget around a balanced budget or a small surplus. But then when you look at the forward spending plans, that surplus does get eroded somewhat. So Australia is still a small cyclical economy. All governments need to manage our debt and manage the budget well. And we've been very lucky to have a number of successive governments that have done a reasonable job. So when we've had the GFC, our debt position was very manageable, whereas for a number of governments, it wasn't. That's an important thing for our economy, for sure.
It's to Labor's defence, it was a tough year to be releasing a budget. Lots of eyes on government's movements at the moment. There were some negative commentary around, for example, that $300 relief for households and energy, that it's applicable to everyone and they should have made it applicable to a certain demographic. I think there were some comments around the fact that the cost of making it applicable to just a certain sector of the population is more costly than just giving the $300 to...
Yeah, you forget the administration of these things.
Just giving the $300 to everyone, and they're relying on the wealthy ones to not bother applying for it. So, Martin, just to wrap up today's podcast, I'd love to know, like I said, the year ahead, the forecast ahead. House prices have had some crazy growth. People don't understand why prices are still rising in certain markets when rates are so high and there's still, a somewhat shrinking economy in terms of GDP and whatnot, and there is no correction in prices. And what's on the horizon in the year ahead then?
Yeah, look, it is a ponderable because, as you've rightly said, with high interest rates, you would normally expect house prices or demand for housing to come down. But that's the whole point. Demand is pretty solid. Whether prices will go significantly higher from here in the short term, we're yet to find that out. But there clearly is demand for housing. The next component is that there'll be hopefully a pickup in construction over the next year to 2 years, which will help supply, but that will also be supported by investors, both domestic and foreign. We're seeing sort of transaction flows from foreigners increasing, so they're looking at the Australian property market, and so that's another component of demand coming through. And then hopefully we'll see some good policies from all governments around things like cheaper housing, which clearly the federal government is talking about. Their ability to deliver is another question, just given what we've already talked about. Supply of building materials, supply of labour that can actually build through construction. These are actually hurdles for the building industry at this stage. We'd like to see some policy changes that might help to assist this. So at worst, I think you'd have to say that house prices will be stable, but given the demand profile, you suspect that probably house prices are going to continue to inch higher.
Given the forecast that rates will inevitably come down, whether it's this year or next, there is probably
that might add to
the
it.
House's view at Macquarie is a 1% decrease. That's
over time.
Over time.
Yeah.
Over time.
Not in one go.
But that means that if prices are staying strong and buoyant at current levels of rates and borrowing capacities, it's only probably going to stay more strong and buoyant in a lower interest rate environment.
Yeah, you'd probably say prices are still set to rise. Just depends how much.
All right, Martin. Well, thank you so much for joining us. Thank you so much for your time. And hopefully maybe in another 12 months we can review some of these comments mentioned today and see if we were right or wrong on certain forecasts.
Love to do that. Thank you.
Thanks, Martin.